Welcome to The Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to The Weekly Option. This is episode 93 on December 21st, 2019. I'm your host, Eric. And in this week's show, we will cover the trades from last week on Intra-Cellular Therapies, Conagra Brands, and American Airlines. And we discuss three new trades on Uniti Group, British Petroleum, and Advanced Micro Devices. Now, it's always great to hear from listeners. If you have any questions about the trades presented here or about your own positions, feel free to email me. You can email questions to me at eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit our YouTube channel for The Weekly Option. Now, as a recap, the U.S. equity markets managed to finish higher over the last week. The Dow Jones Industrial Average grew 319 points, closing at 28,455 points on Friday. The S&P 500 index gained 52 points this week, closing at 3,221 points. Now, time for the topic of the week. And the topic of the week is sponsored by the Option Studio. If you want to learn to trade options without any calculus and confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. So the topic this week is understanding intrinsic value versus extrinsic value in options, and kind of understanding what it might be telling you about the stock. So I was explaining an example actually a couple days ago to someone that I had just met. It was a little holiday get-together. And of course, there's nothing better than talking about options pricing during a happy hour, right? I mean, that's normal, right? Anyway, intrinsic value and extrinsic value is one of those concepts that's so fundamental to options and understanding option pricing. And so many people don't really understand it or don't take a moment to make it clear. So I like to just discuss it a little bit. So for sort of layman's term definitions right off the bat, intrinsic value is the value of the option that is based on the underlying stock. Only in the money options have intrinsic value. And what that means is if you own a stock that's in the money, intrinsic value is the amount of money that if you exercise the option and take on stock, that's the amount of money that you have right off the bat. That's calculated based on how much profit you're going to have. So if you have a stock that's trading for $20 and you own the $19 call option and you exercise it, you receive stock priced at $19, but you could sell it in the market immediately for $20. That means $1 of intrinsic value, right? Extrinsic value, on the other hand, it takes into account everything else. We're talking time value, things like volatility, the market's expectation of where that actual stock is going to finish at expiration, and anything else. So both in the money and out of the money options have extrinsic value, but out of the money options trade purely based on extrinsic value. Because they're out of the money, the options don't have any intrinsic value. So if an out of the money call or put has a price, that price is 100% based on extrinsic value. So let's just use a simple example so you can follow along. And if this doesn't make sense, you might want to grab a sheet of paper just to be able to write the numbers down and follow along with me so that it makes a little more sense. So if the stock is trading for $10, let's assume stock's trading for $10 per share. The $9 call option is in the money by $1. Let's say that $9 call option is trading for $1.15 in the market. So the option is trading for 15 cents of extrinsic value and $1 of intrinsic value, right? And that's because with stock being priced at $10 per share, the $9 call means that you actually have the right to buy stock for $9 a share. So right off the bat, the option itself has at least $1 of value. So the extrinsic part of it is the 15 cents. If it's trading for $1.15, that means that $1 is based on the stock, 15 cents is based on everything else. And we can do an example for put options as well. So let's keep stock at $10 per share. Let's assume the $11 put option is trading for $1.30. So the put option is actually more expensive than the call option, right? So both options in this example would be $1 in the money. So with the $11 put, if stock is trading for $10 a share, that means that it has $1 of intrinsic value. But this put that I said is trading for $1.30. I'm sorry, I think I said that wrong. So the $11 put option trading for $1.30 would be $1 in the money of intrinsic value. But since it's $1.30, it would have 30 cents of extrinsic value. So you compare the put that's $1 in the money versus the call option I mentioned that's $1 in the money. Strip away that $1 of intrinsic value, and you're left with the put having 30 cents of extrinsic value, and the call option that we talked about having 15 cents of extrinsic value. And ultimately, you see what I mean in saying that the put option is more expensive than the call. So I would bet that the stock is headed lower or expected to head lower simply by the difference in option values. And as you get more expensive trading options, you start to be able to look at the premium, the prices that these options are being traded for in the market, and they give you more information about stock and the expectation of where stock is going than you can imagine. So I love using option prices to give to help my stock trading and vice versa. And understanding intrinsic and extrinsic value is one of those little facts that will help you decide which options are expensive versus which side is priced less expensively, and it gives you an idea of where stock might be going. So that's it for the topic of the week this week. Hopefully these topics make sense to you. If they don't, feel free to email me, or definitely take a look at theoptionstudio.com to see if that course might actually be the right next step for your option education. So let's get into the trade review from last week. And of course, yesterday was options expiration. So they're going to be option prices. Any December options you have either are priced with intrinsic value based on the stock, or they went to zero. And that's, as a side note, that is one thing that's different about option trading. So you do have a situation where options do go to zero. It's different than trading stock. In general, your stock will go lower, but it typically doesn't go to zero. It's your options every month will go to zero, or if they're not in the money. So the covered call this week, we looked at Intra-Cellular Therapies, symbol I as in India, T as in Tango, C as in Charlie, I as in India. At the time, the stock was trading for $12.82 per share, and we looked at buying stock and selling that January 14 call at $4.20, hoping for a 42% return over the course of 5 weeks. Now, Intra-Cellular Therapies stock fell 38 cents per share this week, closing at $12.44. The out-of-the-money call we sold increased in value by 30 cents if you were to try to buy it. Now, it actually dropped a little bit. It dropped by about 10 cents on the bid side. So really that 30 cents is indicative of the bid-ask spread. But this leaves us with a net mark-to-market loss if we were to buy out that stock, that call option really, of 68 cents. So the first thing to remember is that we have a break-even price of $8.62 per share on this trade. That means that as long as stock finishes higher than that price per share, we will make a profit on this trade. Now, that's the beauty of selling such a high price call option, is that when we lose money in the stock, we actually have a really nice cushion in the option premium to where we could take it in. And this stock only fell by 38 cents, so that's not too bad. Now, of course, when we lose money on these covered calls, we typically buy the call back and sell a lower strike call option. That would be rolling the strike lower. In this example, we could actually buy back the January 14 call and roll the strike down to the next strike, which is the January 12 half call, $12.50 call. So this January $12.50 call is $4.70 bid. So we could collect at least another 20 cents if we were to buy that call, the 14 call back, and wind this trade down sooner. Now, regarding the 14 call we sold, the bid, of course, is $4.10. So it's actually less expensive now. So that's a good thing. We want that price. We want that call option to go down to zero, or we want the stock to rally and for us to be taken out of the shares of stock. Those are the two ways you win in a covered call. So ultimately, I would sit still in this trade, because rolling the strike down would just create more commissions that will probably eat up the very mild gains anyway. We know our break-even point, and we have $3.80 in profit cushion at this time. So keep watching the trade. This isn't a trade that you sit on your hands and let do its own thing. This is not passive trading. So keep watching it over the next 4 weeks. But I wouldn't touch this. I wouldn't change the trade if this is one of the ones you actually entered. Now, our next two trades took a little bit of a hit. We'll start with the credit spread on Conagra Brands, symbol C as in Charlie, A as in Alpha, G as in Golf. At the time, the stock was trading for $28.38 per share. We looked at selling that January 29-30 call spread at 30 cents, which creates a maximum possible loss of 70 cents per share. So Conagra stock gained $6.69 per share this week, closing at $35.07 per share. The out-of-the-money call spread we sold is now deep in the money, and the spread is valued at roughly its full value, which was $1 at this point. So that means that we will assume that we've lost our full possible loss of 70 cents per spread. Now, this is a perfect example of why it's important to look at what events might affect the underlying stock, might affect your trade before you get in it. So on December the 19th, Conagra had earnings. They actually beat their earnings estimate by about 6 cents per share, announcing, revenue for the quarter of like $2.4 billion. So it was a good quarter for them, and that's why the stock really jumped. So now let's get down to how we might actually make some money in the spread. So the spreads I tend to prefer in this situation are selling spreads of opposite type. So we sold a call spread. I'd be looking at selling a put spread. So you can sell the January 35-34 put spread at 30 cents. Selling two of them could actually bring in 60 cents of premium as this trade goes higher. Now, you would benefit from waiting a day or two before making any changes. We have two strong up moves in this stock. So if you're in this trade, you definitely want to wait and get a sense, because those you had a gap move and two strong up moves. So you want to see if stock is going to have another strong push down, if it's going to level off, or even if it's going to keep rallying. So there are a number of other trades we could consider, like selling another call spread further out of the money just to be able to bring in more premium. But you definitely don't want to do that if the stock is going to continue screeching higher. So keep an eye on it, decide how you want to play it. But at the moment, with stock being so strongly headed higher, I like selling that January 35-34 put spread, maybe selling two of them to bring in 60 cents in all. But you have to watch this stock. And sometimes it's good to just take the loss. I mean, knowing that you lost 70 cents per spread allows you to sort of have a clean break. You can go ahead and turn your attention to the new trades rather than creating a scenario where you might actually be doubling your overall price risk. So the next trade that we did last week was a debit spread. We looked at American Airlines, symbol A as in Alpha, A as in Alpha, L as in Lima. At the time, the stock was trading for $27.48. We looked at buying the January 29-28 put spread for 68 cents, hoping for a maximum gain of 32 cents or a 47% return in 5 weeks. Well, American Airlines stock went higher, grew by $1.56 per share, ending the week at $29.04. The in-the-money put spread is now out of the money and valued at 37 cents, which means that we lost 31 cents per spread. So I would look to sell the January 28, 27 put spread, which is a lower put spread. That'll allow you to collect 19 cents, and you can sell the January 31, 32 call spread at 11 cents. If prices head lower, our in-the-money put spread that we already own would protect us, and the call spread that we sell would actually offset any possible losses against that lower put spread. While I do think prices are going to head higher, the $31 level appears to be near the top of a recent price channel. So if prices go above that, we would look to continue selling additional put spreads just to receive some premium as prices went higher. So the main thing is to track how the risk in your position is changing as you make any additional trades. So adjustments change the risk that you had in your original trade. So make sure you understand the risk before you ever adjust the trade. And that's one of the reasons why I like trading spreads, is that right off the bat, you know what your maximum gain and your maximum loss is. So if you decide to, spend the next couple of weeks in the Bahamas or skiing in Vail or something like that, and you decide to not watch your options position, you already know your maximum gain and your maximum possible loss if you trade spreads. When you don't trade spreads, it changes things. So if you, of course, buy options, then once again, your risk is limited to the amount of money that you pay for the option. But if you sell options, which I actually prefer oftentimes, then you are now open on risk. So I prefer selling spreads rather than just selling outright options. So that's it for this week's trade review. Not happy with the results, but I think I mentioned on last week's show before mentioning these trades that I felt like these trades were just sort of okay. And definitely the caveat to this week's trades is that as of Monday, a number of new strikes are going to be priced because yesterday was expiration, and the new strikes, the have strikes, like the 50-cent strikes between the dollar strikes, will be priced on Monday. So we're going to start off the week on using a cover call, as we always do, looking at Uniti Group, symbol UNIT, U as in uniform, N as in November, I as in India, T as in Tango. Stock ended the week at $8.25 per share. I'm looking at buying that stock and selling the January 9 call at 40 cents, hoping for a 13.94% return, almost a 14% return on my money in 4 weeks. Now you enter this trade by buying stock for $8.25 per share and then selling the January 9 call at 40 cents. This trade makes the most money if stock prices finish above $9 per share. And of course, the break-even price is $7.85 per share. Our next trade on the week is going to be a credit spread on BP, British Petroleum, symbol B as in Bravo, P as in Papa. Stock ended the week at $37.85 per share, and I'm looking at selling the January 38, 39 call spread, collecting 34 cents per spread, and that leaves us with a maximum possible loss of 66 cents per spread. You enter this trade by selling the Jan 38 call at 55 cents and then buying the Jan 39 call for 21 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay below $38 per share. The break-even price on this trade is $38.34 per spread. And our final trade on the week is a debit spread. We're looking at Advanced Micro Devices, symbol AMD, A as in Alpha, M as in Mike, D as in Delta. Stock ended the week at $44.15 per share. I'm looking at buying the January 43-44 call spread, paying 60 cents for this spread, which can leave us with a maximum gain of 40 cents or a 67% return in 4 weeks. Now you enter this trade by buying the January 43 call for $2.46 and selling the January 44 call at $1.86. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay above $44 per share. The break-even price on this trade is $43.60 per share. So that is it for the week. Thank you guys so much for listening. Thank you for the folks that have emailed me. I did send out a couple of the option pricing, the option profit graph spreadsheet that I like to use. I also sent a copy of the free ebook on technical analysis that I'm going to be sharing via YouTube on another channel. But if anyone would like either of those, feel free to email me. My email is eric@theweeklyoption.com. That's ERIC @theweeklyoption.com, or simply go to our website and fill out the contact information. That goes directly into my inbox, and I will certainly get back to you as soon as possible. So thank you so much. I wish you guys a Merry Christmas, and you'll hear from me next week. And I'll wish you a Happy New Year then. So have a wonderful weekend. We'll talk to you soon. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.